Hey everybody, Lawrence here from financialthing.com. Thursday evening, Thursday night, whatever you want to call it. It's the Thursday evening / night investment stream. Peer-to-peer lending, general investing. Welcome to everybody wherever you are watching from. Pop it in the chat tonight. Let me know where you are watching from so I can give you a hello. Say hi to everybody individually like I always do. Sure it's very cold and damp. Maybe some sunshine, who knows? Hopefully you got some good weather wherever you are tonight. I'm still here in sunny Orlando, where unbelievably it got down to 3 degrees. So yes, it does get cold in Florida sometimes, but very rare. Quick disclaimer that this video is awesome, but it's for informational purposes only. This content of the video is not financial advice and has been prepared without taking your objectives, financial situations, or needs into account. You should consider its appropriateness for your circumstances. All investing carries risks. Opinions expressed in this video are opinions based on my own personal experiences, and the FSCS does not cover peer-to-peer lending or most other investments. And your capital, of course, is at risk. Please don't invest more than you can afford to lose. Excuse me. Just grab a quick drink. So, today is December the 3rd, and unfortunately I have some bad news. It happens. But there is some good news. 2 pieces of good news, 1 piece of bad news. The bad news is through things that are out of my control. CEO of Cufflink will not be joining us this evening. Narinder had to reschedule. He had some personal issues that prevented him from being here with us this evening. It happens. But he said good news. The good news is that he will be here next Thursday on the 10th. Hopefully he will follow through on that, because I was left a little bit stranded today with my information about what am I going to talk about on the stream today. Second piece of good news today, aside of going through our peer-to-peer lending news that we always do, which we will still do today, we're going back to school. The St. Martin's issued Grimsby Town St. Martin's Preparatory School, where I spent my youth. You can see here. Look at that. That is authentic. 6 5/8. I don't know if that's some kind of a hat size. It must be very old. We're going back to school today. We're going to learn a little bit about a investment strategy. This looks terrible. I mean, it's obviously not a good look for me, but we're going to learn a little investment strategy that I've been testing for the last few months. I know that the way things are going right now, everybody's looking for ways to increase yield. Interest rates are crap. Peer-to-peer lending rates, in some places are good, some places are not so good. Some people are disillusioned with peer-to-peer lending, let's be honest, with what's happened with lending and collateral and funding secure, and some people have been burnt. So we're going to learn a little bit about a strategy that I've been trying since started in August of 2020. I'm going to share what I've learned and let you know about that and see if it's something you want to have a dabble in yourself. Another thing is, last week I said this week I would have a new peer-to-peer lending company for you, and I've completely half-failed. No, is that even something you can say, completely half-failed? I half-failed because I didn't complete my research. But I'm going to give you the information of what the company is tonight. So for everybody that's here, you're going to be receiving that. And I'm still going to donate the money to charity. I said if I didn't have that information in full for you this week, I'm going to donate £100, which I will do. And it's that time of giving where I do try to give to charitable causes. And where I'm going to be donating to is my good friend, Dr. Paula Donda, who is in a place called Kelseyville, California. I'm just going to put this up on the screen here so you can see it. If anybody's interested in learning about her cause. Let me go ahead and share this with you. Where is my share? Bingo. You can go to her website, worldwidehealinghands.org, and she goes on mission trips all around the world. She's a doctor and gives up her time. She helps mothers in obviously very low income, very undeveloped countries who kids are suffering, pregnant women suffering. So she goes and gives free medical care. Some of these women walk for days to come see her. They see thousands of people a year. So it's a cause that is close to my heart. So I'm going to be donating some money to her. And again, if you are interested in learning about what Dr. Paula does, I'll put the link in the chat. It's cool. I like it. I like people who are up to things like that. I think giving to causes is an important part. I have to get my screen. Yeah, this is her organization right there. So I'm going to be sending money to her. And then hopefully by next week, I will have the full information for you about the Peer-to-peer lending company. So if you can, just hit that thumbs up for me. And we're at 10 right now, 36 people on the stream live. So if we can get that up to 25, 30, even better, 36, that would help me out a lot. YouTube is coming down on us small streamers a lot. So if we don't get that thumbs up and, the subscriptions, they tend not to show our videos. But thank you if you have hit the thumbs up already. Let's go ahead and say hi to everybody in the stream. We have Annabelle. Hola a todos, ¿cómo está? ¿Cómo te sientes, Annabelle? How are things in Spain? First in class today. Yes, you are. Keen and attentive. Excellent. We're gonna have a lot of learning tonight for anybody that's interested in a way of investing that you might not be familiar with, to do with stocks and shares. We're going to be in class today for a little while. I get excited about that kind of thing too, because, as you know, I'm very much into index tracking investing, but there is a little part of me that has that gambling side. And while I don't like to gamble on single stocks, I found a pretty conservative strategy that will allow people to possibly dip their toe into the idea of doing some smaller amounts of investing without as much risk as you might think. So I'm going to tell you about that. Hi, Paul in Kenilworth. Paul Bagworth is here. Alan Toombs in a cold and wet Basingstoke. Would I expect anything less from Basingstoke in December? Probably not. Peter Vince, hi to you. Well done, Annabelle. He says, hello from a very rather moist Leatherhead. I should put that up on the screen. There we go. Moist. Yeah, that's one of the words that people are saying is offensive now. I don't find it offensive. I mean, when you eat a cake that's soft, it's moist, right? But who knows? Politically correct things going on right now. Colin Perry, hi, nice to see you from the Peak District. John Cutler in sunny Blackpool. We have Steve in Solihull. Stephen Green in Southport. John Day from Nottingham. Stephen Haling in Nottingham. Everybody's going up on the screen today. This is new. Keith Morris in Lincoln. Dave Dawson, Double D from Staffordshire. UK Soul 2001. Early morning greets from Tokyo. Konnichiwa. I think I said that right. Chica Boy is here from Folkestone. Nice to see you, Chica Boy. Who else do we have here? Brian from Woburn, of course. Again, if you want to check out my giving charity that I like to support, worldwidehealinghands.org. Robert Pates, hi from Crete in Greece. Nice to see you. It's got to be a little bit warmer, hopefully, than the UK at the moment. See, Norman from a very wet Sussex. And Wayne Bernard from Kent. How are you? Did I put Robert up on screen? Robert Pates from Evening Paul Lockdown. I don't know where you are, Robert, but hi, and Wayne again from Kent. Nice to see everybody. We have about 40 people on the stream. So let's go ahead and move through our peer-to-peer lending news this week. It's very, very quiet, probably the quietest that I have seen since I started doing this live stream. Not really much has happened this week. Let's do our Loanpad update. Really not much changed. Loanpad's still on my top 5. One of my preferred places I think is good in the peer-to-peer lending world at the moment. Same loan book as last week, almost identically, 39 loans. £15 million loan book secured on £40.2 million of security. Average loan to value 34%, 39 loans. 1 default, 2 extended, 3 overdue, and 2 loans continuing to be serviced by the interest coverage fund, which is 40,000, but 27,000 is being serviced now. So by my calculations, that would mean there's 13,000 left on the interest coverage fund. Is that right? Did I do that? 27. I need that school cap back. Yes, 13. So let's talk about LendingWorks. We had a email this week, and for anybody that's not familiar or you're not an investor of LendingWorks, you'll know that they are currently charging negative interest rates. I'm going to go ahead and put this email up on the screen. Just kind of give my thoughts about what is going on with LendingWorks. Here we go. Did I get that? There we go. Let's close this stuff out. So that's not what we want to see. Come on. All right. Still learning how to do this. We are pleased to confirm that the investment into LendingWorks that was announced in July will complete in December. That's the Intriva Capital buyout of LendingWorks. So that's going to be an investment funded into their new business. We'll see what happens with that. It says the company's new investor has committed to funding our entire long-term business plan, meaning we'll be resilient and stable as a business and a platform. Definitely good news. Anytime capital injection comes into a company like that, it's really a good thing. There's nothing negative I can say about that today. So they're going to restart their lending. They've been in a pause of lending and taking on new investors for a while. I think that happened in, let's say in June or May of 2020, where they paused everything. They're going to restart lending the week of January 4th, 2020. They say that their shield coverage cushion is going to be higher because they're expecting higher default levels. And here's the news about the normalization period. This is where they are charging the 2% service fee to cover the cost of servicing the loan portfolio. Going forward, these funds will be paid directly into the shield fund. So they're calling that negative interest to lenders, which means for every £100 you lend over the year, they're estimating that you're going to get £98 of capital in your account. So you're actually losing £2 out of every 100. First time I've ever seen that in peer-to-peer lending, especially being called a negative interest rate. It's really a fee. But they're going to now put that 2% towards the shield fund. And they said, however, as previously communicated, the secondary market for loan sales will remain unavailable. That means you won't be able to sell. They're going to provide a further update on this in December 2020. What I think the reason for that is because if you're getting negative interest rates and you're being charged a 2% fee for LendingWorks to lend your money out, if you have a secondary market, what's going to happen? Everybody's going to leave. Nobody's going to leave their money in there to be charged. That doesn't make any sense. So they're not going to start their secondary market until they get rid of that 2% fee. I completely understand that. It sucks for us as lenders because we're getting charged. But the one thing that I'm confused about is when this lending restarts, who's going to reinvest their money? I mean, personally, I'm taking out when I get paid a capital or interest payment, it comes out of LendingWorks into my bank account because I'm not going to re-lend it and be charged 2%. Plus, I'm not making any interest. So that makes no sense. I think if they allowed secondary sales in LendingWorks, allowed people to exit, everybody would just leave. So they probably can't do that. LendingWorks Shield, following the Q3 performance update, the additional required Shield funding is now being diverted from loan payments to the Shield. You can see the impact this has on your investment returns in your dashboard in 3 places on the chart and figures on the loan page. So if you log into your dashboard now, you can see a little bit more information about the impact of these Shield payments on your account. It's still not very transparent. I mean, I still don't understand how they calculate what they take out at what time, other than what the rep told me last week, which is the first 3 months are going to be more severe. So you might see more of a chunk of money coming out of your account of the 2% at the beginning, during that first 3 months, than you would later on 6 months, 8 months, 10 months in. But it still doesn't, it's not stated anywhere. It's really not transparent. I definitely want to see that change. LendingWorks needs to tell us how they're calculating this and how it exactly works, because we're already getting a bad end of this deal anyway. So at least if you're going to give me the shaft, let me know how I'm going to get shafted. Anyway, look, I hope this 2% thing is going to be gone. I would imagine, if I had to take a guess, spring, maybe summer of next year, 2020, that will be eliminated. It has to be temporary. There's just no way people are going to continue and invest if they're being charged a 2% service fee. It's not going to happen. What else? We want to reiterate that due to the timing of the loan losses occurring this winter due to COVID, the phasing of negative interest rates is such that the impact is significantly greater for the 3 months. Then it is forecast to ease materially after that. We will, of course, update you on the performance of the portfolio and the impact this will have on your returns. Blah, 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 blah. Summary: this year has certainly been the most challenging year LendingWorks has faced since we launched in 2014. We are very disappointed to have to inform retail investors of both the normalization period, the 2% fee, in each of the that we triggered in April, as well as the reduction in expected retail investor returns. Once again, thank you for being our customer. Yeah. So, okay, it is what it is, right? I mean, we're all in the same boat together. And if anybody that's invested in LendingWorks, you want to see the company survive. The last thing you want is another peer-to-peer lending failure. COVID has really done a number on them in many ways, but they're not alone. It's happened to many other investment companies, not just within the peer-to-peer lending. So I can't be too mad at them. What I'm a little bit annoyed at is, why is this Intriva Capital not injecting money to cover this 2% fee? Like, why is it falling onto the investors' shoulders? And I can be quite happy with zero interest, right? But taking a loss in capital, to me, is not really where I want to be. So, but it is what it is. There's not really much you can do to change it. So you just accept it and continue on until they decide to change things. In other news, Mintos. If you haven't seen it, I've kind of updated my Mintos, or Mintos, whatever you want to call it. The mint, the fresh maker, peer-to-peer lending platform based in Europe, is renaming their buyback guarantee to a buyback obligation, which I applaud. I think that's really good. I think that's good, because the buyback guarantee is very misleading. This is the problem with these European peer-to-peer lending companies outside the UK, is they're not really regulated, so they can pretty much write whatever they want. And having a buyback guarantee, the word guarantee, is very misleading. It kind of got me when I first started investing in Mintos. I thought, I'm guaranteed that whatever I invest in those loans, I'm going to get my money back. Well, some of the loan originators that put their loans up on Mintos' platform, Mintos is a big loan aggregator. By the way, they don't underwrite their own loans. But they put these buyback guarantees on there, and then some of those companies folded and went out of business or went into default, which meant the buyback guarantees were worthless. So it's not a guarantee when it's not guaranteed. The only thing you can guarantee is like a bank account with FSCS protection. And even then, there's no real 100% guarantee, because if your government goes bankrupt, then they won't be able to afford to pay you your FSCS money. So I never think anything is 100% guarantees. But Mintos is going to rename that word from guarantee to obligation, which I think is very, very fair. That's the way it should be. Other news, Bridgecrowds, they have posted a net profit of 2019 and 20 of £3.7 million, which is good. I mean, you don't hear of peer-to-peer lending companies posting those kind of profits normally, especially the troubles that we've had. But then that ended in April 2020, so it'll be interesting to see next year what their 2021 results are like. But they've rebranded themselves as Somo. And they've also got themselves a 300 million euro investment backed by Deutsche Bank. That, by the way, is one of the most difficult words to spell. I don't consider myself illiterate, but Deutsche, it's just not an easy word to spell. So what that tells me is Bridgecrowds is going to go institutional. And I think you're going to see some of these bigger peer-to-peer company loan books, they do go institutional because it makes sense for them. Why? No, dealing with retail customers like me is a pain in the ass for peer-to-peer lending companies. They have to pay more interest. They have to deal with all of the customer problems, people calling up and saying, why have you reduced my interest rate by 6p this week? And my dashboard isn't working. And we give them a lot of hassle sometimes. So you saw it with Lambo, right? Went institutional. Bridgecrowds, 300 million euro investment through Deutsche Bank. And I think you'll continue to see it happening more and more. I expect Zopa, I expect Funding Circle will all go institutional. And I think peer-to-peer lending in the long run will become probably more boutique. It makes sense. Bridgecrowds has got an access to 300 mil that they don't have to deal with retail money, and they could just lend their money out like they normally would. And it makes it easier for them to know how much money they have to allocate towards lending. When you're doing peer-to-peer loans, you never quite know how much the crowd is going to invest. If you look at some peer-to-peer companies, they're having problems filling their loans because they don't know how much investors are going to put in. Sometimes investors like us, we don't know how much money we have available. So having an institutional credit line of 300 million euros means they can just fill whatever loans they need to fill. Same with what Lambe did. Assets capital discount this morning was 3.6%. So you've seen a real leveling off with that rate. If you want to try to exit out of there, you can get out for 3.6% at the moment on the quick access account. Zopa is adding a new investor wait list. This is interesting. I remember when Zopa's demand was super high and they didn't have enough loans to fill too much investor money. Now they're having to put a wait list because the queue times have become really long. I think last time I checked, it was taking 34 days to get your money invested. So they're going to put a new investor wait list like old times. If you want to become a Zopa investor, you're just going to have to wait in the line. I found that really interesting. We had a Funding Secure administration loan recovery this week, which it was good news. It was good news. I'm kind of used to seeing bad news when it comes to Funding Secure. And I'll say was it good news? I think it was good news. They recovered 92% of capital on a hotel in Wales. So 8% loss of capital, and for a company in administration, not the end of the world, but it is what it is. Again, I'm happy to see that. By the way, if you haven't already and you're new to the stream or you haven't yet, join the financial thing. I have to do it opposite. It's hard. Facebook group. If you Google it, Financial Thing Facebook group, or do a search in Facebook, you will be able to come join us and join the discussion. We discuss lots of things investing there. It's a fun place to hang out. If you got nothing else to do, come hang out at the Financial Thing Facebook group. I'm going to post the link in the chat here. As you noticed, I'm not the most professional streamer. I don't have anything ready to go. I'm just an amateur, fumbling and fiddling my way through this, trying to think of something interesting to tell you. So yeah, join that. Let me get rid of that. Boom. Okay, what else? What else have I got to tell you about peer-to-peer lending? Before we go into our education session about some stock stuff, I think that might be it for the peer-to-peer. If you have anything you want to know about, maybe that I didn't cover this week, as I said, it's a pretty quiet week. Everything has remained as usual, especially in my own portfolio. Just to give you a quick update, I haven't really changed anything. I've got to update the website. If you go to financialthing.com, you'll see a link in the top menu that says where I invest. I'll be updating that probably today or tomorrow. Nothing has really changed at all. I'm just withdrawing interest and capital payments from my peer-to-peer lending. I'm not really trying to exit anything at the moment, just leaving it as is. Got allocations in Loanpad, assets, capital, a bunch of other places that you can see if you go to the website. And pretty just holding on, seeing what happens. Everything seems to be going as per normal. So let's talk about the new company that I've been checking out. Where's the link? The name of this company, and I spoke to the owner a few weeks ago. It's called Lendery. There's my registration link if you decide you want to sign up for it. That's a referral link. Now, what Lendery does is they basically take our money and lend it to cryptocurrency traders. Now, when I first heard that, I thought, oh, this is risky, right? I mean, cryptocurrency trading is extremely risky, but when they explained to me how it works, I was actually pretty impressed. And this is the reason I decided to really take a good hard look at this company and see if it really is a viable place to invest. Let me show you this. Where is it? Here we go. So I think the average lending return has been about 19%. Now, it's basically crypto traders have the option to receive margin. What margin is, it's basically like a credit line. Give you a very basic example. They put in £100 of their own money, and the crypto platform will give them an extra £100 on top of that to trade. So it's basically like leveraging 2 to 1. Some people are able to get higher leveraging margins than that. If we keep it simple at 2 to 1, you put in £100 of your money as a crypto trader. Say Coinbase or whoever, they give you an extra 100. So now you got £200 to trade. What Lendery does is it lends the £100 to the cryptocurrency trader, and in return for that, the cryptocurrency trader pays interest on that loan money. The cool thing about Lendery is that they have a way to tap into these cryptocurrency platforms through an API, and they control the risk by ensuring that if a trader's trade goes bad, their positions are closed out before it gets down to a position of a low point. So, for instance, let's say they've got £200 that they're trading. Remember, £100 is leverage and £100 is the trader's own money. If their trade drops from the 200 down and down and down and down. Let's say their trade isn't going well and it gets down to the £100 mark. Instantly, Lendery's API is going to close out that position to make sure that your capital of £100 that you've lent is secure. Now, I don't like to use the word safe because there's always risk, but having that automatic closeout position means that there is that bottom that trader cannot go under. So if Lendery didn't have that option to close out the position, what could happen is the trader could have his £200 position, and say crypto's having a crappy day. He's got his Bitcoin or whatever, his Ripple coins, and it's going down and down, and it goes to 110, 100, 70, 60, 50, and the bottom's falling out. Next thing you know, your money's gone, and so is the trader's money. So Lendery has that automatic closeout positioning to be able to stop that from happening. So that's where I am with it. You can check it out. It's pretty interesting. You can see the expected annualized performance here is 18.43%. I tried to really figure out, to get returns that high, you have to be taking some amount of risk. I guess the thing about these crypto traders is they're willing to pay quite a lot to borrow margin money, and therefore you get high returns. What are the risks? I guess the crypto platform goes bust, and then you would probably lose your money because sometimes these crypto platforms get hacked. Unlikely, very unlikely, but I haven't really seen too much risk on the downside for what you're getting. We can look at what are the risks. Here we go. Credit default risk. The exchange has implemented an automated margin protection mechanism that liquidates any position in a trader's margin account before the trader would lose his ability to pay back the capital and interest rate. So there you go. Exchange risk. Your funds will sit on Bitfinex, which is one of the oldest and most established crypto exchanges. However, crypto exchanges are still seen as niche players by large financial institutions due to their relatively young history and regulatory status. This leads to a certain risk premium, which is also reflected in the interest rates above. So that's basically talking about if Bitfinex, which is one of the older crypto exchanges, similar to Coinbase, if Bitfinex bit the bullet, that's the risk of having your money in there. I think that this is one of those cases where I probably wouldn't put too much into an investment like this. I test it out, see what it's like, and try it out from there. But it seems like a really interesting concept, how it works. I don't have really too much more information today, but I think that's going to be one of those things I'm going to have to invest some money in it, test it out, see how it goes, and then report back, which is the way that's the way I do my reviews on financial thing. I don't review companies that I haven't invested through, just so I can kind of report back and see how things are. But I find it very, very interesting. I think cryptocurrency is going to do well over the next several years. I've spoken a lot about that. So that type of investment interests me because I know people are very heavily into crypto trading. Crypto traders like to borrow money. People like us can lend it to them if they need it, and it's kind of a win-win for them, a win-win for an investor. So we will see what happens with that. Okay. If you have any questions or comments, pop them in the stream. Mike said, you said you would have it. Hi, Mike Powell. Nice to see you. You said you would have it next week as Cufflink was on. Oh, so you're right. I did say that. But then again, so you get a bonus this week. But I'm still going to donate the money to charity because I feel like I didn't come as fully prepared. I really thought I said it was going to be this week. But you're right. That wouldn't make any sense because we were supposed to have Narinda from Cufflink on this week, but he had to reschedule today. So there you go. Let's see what else. Anything else in the? I'm just going through your chats. Fair play. Thank you, Paul Bagworth. Fair play to me. I don't know what I did, but thank you anyways. Cheeky Boy says he's done his thumbs up. Annabelle said, you must have known you had your school cap at the ready. You know I didn't, because I went in a box when I was trying to figure out what I was going to talk about today. About an hour ago, I started working on this little lesson plan to teach today, and I went into an old box that I have, and I was looking for my graduation cap from university, but I couldn't find it. But what I did find is that tiny little cap that I threw earlier from St. Martin. So there you go. Pretty cool. No Aki chap tonight. Richard said, "Is in peer-to-peer boring is surely a good thing." Yes, that means that we didn't have any bad news this week. We didn't have any particularly good news. Richard McDougall, hi, nice to see you, Richard. Unsecured loans are not great in a downtown. Downtown? You mean downturn? Hopefully Lending Works can improve as the economy recovers. I think they will. We got to give them some time. Hi, Aki chap. Nice to see you with your cookie. How are you? The comedy duo. John Day says, regarding Lending Works, is the 2% fee labeled shield contribution adjustments in the transaction report or elsewhere? John, to be honest, I haven't logged in to look, but let me log in and see if I can even spot that. Maybe somebody else knows. Your comments are on a bit of a delay, by the way, so you may have already, this may have been answered already. But let's see, where is it? View account, statements. They're in here somewhere. I don't know. Where is the statement? Oh, there we go, statements. Transaction history. No, I don't want that. 2020 statement, select month. Maybe it's, I don't know. I'm not sure. Maybe somebody else can tell me where it is in here, because I don't see it. They say it's in there, though, somewhere. Richard says, since the assets capital buyout rates is only 3%, I did exactly that and invested proceeds in crowd property, Proplen, Cufflink, all paying 6.5% to 8%, 0 defaults, and apart for a few B loans and Proplen. Makes sense. Do crowd property pay out on some loans monthly? Last time I checked, no, they do not. Lending Works, do you still recommend sitting tight with them for long term in hopes that positive interest rates return eventually? I would say remove your capital and interest as it comes in. Don't really have a choice at this point. You have to stick with them because there's no exit. But I wouldn't reinvest at all. There's no point. Oh, sorry. I guess I muted myself for a minute there. I'm back now. I got a couple of thumbs down. I told you I'm a complete amateur. I need to move that mute button. I've got this mute button right next to a button that I press a lot. And yeah, let me go ahead and revisit some of these questions that you asked. So Aki Chap asked if Bitcoin has come onto Trading 212 now, if that's something you should invest in. What I was saying is some of these apps that offer Bitcoin do not allow you to withdraw the Bitcoin into your own wallet. So if you can't withdraw the Bitcoin from Trading 212, which I believe you cannot, you don't want to buy it because it's not really actual Bitcoin. If you're buying actual Bitcoin, you would be able to remove it to a Coinbase wallet or a Nano wallet, hardware wallet. You can't do that. So I would say only use Coinbase or Binance or one of those other trading platforms to buy cryptocurrency. I would not buy it through Trading 212 if you can't take it out of there. They've got some convoluted way of buying it. It's almost like it's a fund, a Bitcoin fund. It's not actually really Bitcoin, so no. What else? Mike said that Lendery is German, so no FCA protection. Absolutely true. That's why you're getting a higher interest rate. Martin, hi Martin, nice to see you in Leeds, I believe. Nice to see you, Martin. Yeah, Robert, I did. I muted. I'm sorry. It happens. It happens. He looks pretty strange with no voice. Yeah. Hi, Arthur. Arthur Atkinson, nice to see you. Cyril is here. Can anyone lip read? No. Oh dear. I know. Lawrence, rewind. I don't know what to rewind to, Mark. I don't. Nice to see you here, Mark. Thank you for the thumbs down. I was starting to wonder what I was saying that was so bad. Like, I'm getting some thumbs down. First time ever. Yes, I'm back. Okay. So continue to put your comments in if you have any other comments. We're about to go to school today. This is going to be, this is a strategy I've been testing for a while. Some of you may know about this already. Some of you may not. Some of you may be intimidated by this. We are going to look at, options today. Options and stocks and shares. So if anybody owns stocks and shares and you have any decent amount of holding, this may be of an interest to you. And the reason I started looking at this was I was trying to figure out where can I get some yield, where can I actually make some income without having to risk too much in peer-to-peer. You know, I'm a big diversification guy, and that's why I started looking at options. Now, there's a very risky way to do options in stocks and shares, and that's naked options, where you pretty much, you don't have to put out the money, you do it all on credit, and it can be extremely volatile. But we have a way of doing it that's definitely a lot more safer, where you can really eke out some nice steady returns. So I'm gonna give you a quick lesson on that, and I hope you kind of like it, because it's really been of interest to me recently. One thing I do want to say is that majority of my investment funds are in index trackers. You know, I'm a huge fan of index trackers. I've been talking about this for years. So I would say about maybe 7 or 8% of my entire investment that I put into the markets is done now through this form of options trading. And it's on stocks and shares that I really want to own, that I don't mind owning long term, that I don't mind hanging on to. Let me just ask these questions. Cyril says, ever looked into abundance crowdfunding with a green angle? I think that I have looked into them, but I've pretty much got as much money as I'm willing to put out into peer-to-peer lending at the moment. So if I can get a repayment maybe from some of the stuff that I have out there, I might look into abundance, but I haven't looked at them for a couple, 2 or 3 years. I did keep it, check on them a little bit a couple of years ago, but it wasn't. I like the green angle, yes, but I just had too many platforms at that time. So I know a lot of people do invest for abundance. I forget if it's Archover or Abundance that has the £1,000 loan minimum. Cannot remember. How it works. How much do you have to put in? I know one of those. I think it might be Archover that has £1,000 minimum, but oh no, you can access as little as £5. So yeah, I'll check it out. I haven't looked at them for a while, but I like their new website. It looks pretty clean. So I'll check out Abundance. Maybe I'll, in a couple of weeks, have a bit more information on them. Anyway, so here's what we're going to look at. We're going to look at options trading today, and it's not necessarily trading. It's more like I would say it's more. I do it because I want to hang on to stocks, and I don't mind holding them. So I'm going to give you a quick lesson. This is called the wheel strategy. Now, my terrible handwriting, that says wheel strategy. And what it is it's a wheel that you can use a circle, right? Imagine a circle. There's 2 strategies to it. One is called cash secured puts, and the other is covered calls, right? A cash secured put means we are setting a purchase price which is below the current trading price of a stock. So for instance, if you like, I'm just going to make up numbers here. Let's say Lloyds Bank is trading at 40p, right? And you want to buy Lloyds Bank for 35p, and you're willing to pay 35p. There is a trader out there that will pay you to take that option to buy Lloyds Bank shares at 35p. Now, the thing is, you need to know this about trading options in the UK in this manner. One options contract is 1,000 shares. So you'd be obligated at the end of the time to buy those shares at that price if the shares hit that price. Okay? So, I'm going to give you an example. This is the first part of the wheel. Again, this is called a cash secured put. And what you're doing is you're setting a price below of what the share currently is. So one of the shares that I recently bought in the Trading 212 portfolio, if you look at my videos on my portfolio, you'll see I bought this company called Magnite. And Magnite currently today was trading, I think, about $19.50. It's gone up a little bit here. It's $20.22 at the moment. But let's use this example of $19.50. Right, so today Magnite is $19.50. I can set an agreement to buy Magnite shares for whatever price I decide. But let's say I'm willing to own those at $17.50. I like the stock. I don't mind owning it. All right, and what I can do is set that strike price of $17.50 and with that trader and agree to buy them, and I can set a pricing date. So if that price falls below it has to be below $17.50 or below, I would get that share assigned to me, and it would all happen on January 15th or before that. Okay. Now, the price of that is going to cost me, I'm using US dollars here because this is a US dollar stock, but the price of that is going to cost me 1,750 US dollars plus the commission, which the commission is very small on these trades. Maybe, if you do it through interactive brokers, maybe a 15 cents to $1 for the option. I tend to choose a 1 month option time, because 1 month is generally, you don't want to put it too far out. The longer out, the more volatility and fluctuation goes, but also the longer the contract is out, the more money you get paid to take this contract. Okay. So what that trader is going to do is they're going to pay me a premium to take this option at $17.50. Now, I know this sounds like it might be a little bit complicated, and I may be losing some of you, but just think about this. Current price is $19.50. I don't mind owning the stock at $19.50. If I bought it today, I would buy it at $19.50. But I can get paid to say I'll buy that stock at $17.50, which is a $2 discount, which I'm happy to own it as, and I get paid to do that. Okay. So let's presume that the price hits $17.50. There's a premium right now. Remember I said that they're going to pay me to take that stock at $17.50. So what's going to happen if that stock does hit $17.50 by that strike date? So let's say January the 15th, 2021 comes along, and the Magnite share price at that point is $17.50. Immediately, those shares get assigned to me. Now, I get a premium of $118, right? That's the share pricing, and I'm going to show you how that pricing is figured out. But I will have received $118 as a premium when I made the trade at the very beginning. I get to keep that money, whatever happens, okay? And also, I've gotten these stocks at a discounted price of $17.50. So now my total cost for that Magnite share, instead of being $19.50 is the date that I wrote the option, I now just paid $16.32 for the share. Now, this is on a US stock. If you do it on a UK stock, you've got to have 1,000 shares in a contract. So it becomes a little bit more tricky, especially on a higher price share. I like doing it on the US stocks because I can pick stocks that are sort of in a lower price range where I can, I don't have to pick up 1,000, I can pick up 100. All right. Now remember, these are cash secured, so you got to have the money in your account to make the trade when you first write the contract on the option. All right, that's very important. So there are ways to do it on credit, but I don't recommend it. It's very risky, but this way I have the money in the account. So if I do get assigned the 100 Magnite shares on that date, then I've got the money in the account to pay for it. Okay, so if that price of $17.50 is not reached, I get to keep the premium and I don't own the Magnite shares. So I got the $118 US and nothing else out of pocket. So let's say the price is $18 or $17.75. The strike price didn't hit my $17.50 by my date that I had purchased the contract for, and I get to keep the premium. Okay, so what's the pros? And we're going to show you the pros and the cons. The pros are we keep the premium no matter what. If the strike price isn't reached, you don't own the shares. We get to buy shares we want at the price we set, and we get paid to do that. So we're going to buy the shares anyways. Why not do it at a lower price that we get paid to write the option on? And also, you can close out the trade early. If you see that the price is getting further towards where you want to buy or further away from it, you can close the trade out early. You're going to pay for that. But generally, for instance, let's say your Magnite share is gone up to $21. Now the price to close out that trade early is very small. You'd repay the trader back the premium, but it's just a very, very small percentage of it. So you can close them out early. And let's say you you decide you don't want to take the shares anymore. Maybe you just change your mind about Magnite. You can close the trade out. So the cons are this. Let's say you get assigned the shares at $17.50 and the price continues to fall down to $16. Now you have paid $17.50, which is actually a little bit less. Because remember, we only paid $16.32 because we got the premium. That reduced our price. So, but let's say even though we paid $16.32 for the option shares, let's say the price goes down to $15. Well, now you've paid $16.32 and the price of that stock has continued to fall. You have to buy it at that price of $17.50 that you set the contract on the option to be. Now, it's not the end of the world, because think about it. If you were going to buy that stock anyways, you bought Magnite at $19.50 and it went down to $16.50. You know, we all know that the only time you lose money in shares is when you sell them. If I'm a long-term investor, I'm going to hold on to those shares long-term. It doesn't really matter to me that much that the price has fallen. So I'm going to own the shares anyways. So, oh well, the price has gone down a little bit. I'm in the negative. Not the end of the world. Another con, the shares may not fall below the strike price, which means we don't own the shares we want. If that $17.50 price isn't hit, then we don't get to own the shares we want. So we own nothing. That's a bit of a con if you really have some shares that you really want to own. You also need enough cash in your account to buy 100 US shares or 1,000 UK shares. You got to have some money in your account to make a trade like this. And it can be riskier if you have a small trading account. You know, if you've only got £5,000 that you put into the stock market and you're using 1,000 or 2,000 pounds on one stock, you're not diversified at all, so it becomes very risky. You know, picking out single stocks can be pretty risky. That's why I said I only use about 7 or 8% of my entire trading to do stuff like this. Okay, so the second part of the wheel, remember that was just one part that was called the cash secured put. You can write a thing called a covered call. Now, this works for people that already own shares. Let's say you already owned 100 Magnite shares that you bought a year ago, or 100 Barclays shares, or 100 Amazon shares. Imagine owning that many of those. So if you own these shares, you can actually write options against those shares that you own, and in the same sense, you'll get paid a premium on the market to write a thing called a covered call. And what that essentially is, a covered call is just the opposite. You're not setting a price below what the price of the stock is. You're setting a sales price. So you're saying we set a price that we agreed to sell our shares at a certain amount. So let's say we bought Apple stock for $100. We can set a thing called a covered call that we agree to sell those shares for $110. Okay, whatever happens. So now we're writing a contract to sell at $110. What that means is we get paid a premium to do that, and we also would make $10 a share. Okay. So let's look at the example on Magnite. We own 100 Magnite shares, and that's one option contract on that US stock is 100 shares of Magnite. That's one options contract. The current Magnite trading price, and we own these shares, is $19.50. So we're going to agree to sell Magnite shares for $22.50 per share. That's the strike price. And we're going to agree to do that on or before January 15th, 2021. So the trade that we do, there's always a person on the other side of a trade, remember. It's usually either an institution or just a private investor. But that private investor is going to pay us a premium to write that option. Okay. Now, I'll show you what the premium is just so you can see an example right now. This is a US company called Robinhood. And this is the Magnite trading on the option. Now, right now the price is $20.11. I can agree to sell my Magnite shares for $25 US, which is a $4.87 uptick, right? On January 15th, 2021 for $1.87 $2.08 per share. So remember, it's 100 shares on the contract. So I'm going to get paid 108 bucks, 108 US dollars to sell this contract. Now remember, these are shares I already own. I have no emotional connection to these shares. If I let them go, it doesn't matter. I'm going to make $4.80. Now it's just dropped to 86 cents for that contract. I'm going to make that times 100. So I'm going to make $4.86 per share on the increase up to 25. And I'm also going to get paid $108 on that premium. Now, if I change these dates, I go to the March 19th, which is even further out, you'll see those premiums increase. So if I sell that for $25, now I'm getting a $2.43 per share premium. That means I'm getting $243 on the premium to sell that option. So I'm going to make $243 if that share price hits $25 and I sell those shares to the other person in the trade. I'm going to get $243 plus $4.85 per share extra. So that's $485 and 243 bucks. So I'm going to make a nice little chunk of change on that trade, right? Now remember that when there's a trade, there's always a winner and loser. So I'm going to explain what happens if the price of the stock drops and some of the pros and cons. So you can see we'll be paid the premium. We have to pay a small commission. It's usually only a few cents up to $1. Generally, a 1 month trading option contract is the best. You don't have too much time for the volatility to really strike. But the longer you go out, the higher premium you'll be paid. Now, if you look at something like Apple, you're going to see different types of monies. You'll see a lot more options too. But if I'm going to sell Apple stock right now is $123, let's say I own 100 shares in Apple, and I say, okay, I'm going to sell Apple stock for $126, so I'm getting a little bit less than $3 per share premium, that if it gets executed, I'm going to make $3 per share, so that'd be $300. Plus I'm going to get an 8 cents per share premium. That's that's not very much. It's not very much at all. So you're only going to make $8 on the premium. Now, this is because there's a lot of people out there, traders, that believe Apple is going to go up, right? So the premiums are low on the uptick. But sometimes if I move this date to, remember, that's for December 4th, so that's today. If I move it out to December 24th, you'll see these premiums change. So now, at $126, the premium on 100 Apple stocks is $242 for a contract, or $2.43 a share. So I'd make that uptick of the little bit less than $3 on the share, and I would get paid this $243 premium. The further I go out, the higher the premium. If I go all the way to January 15th, 2021, and I want to sell my 100 Apple stocks for $130, which means I'm getting $7 on the uptick. So that's $700 plus $313. So I'm making $1,013 for the trade. It's pretty good, right? If it doesn't get executed, if the stock is only $125 in January 15th, 2021, then I get to keep the premium, right, of whatever we choose. Say the $2.03, so I'll get the $203 premium, and I still get to keep the stock. So that's the example. So let's presume that the sale strike price of the shares that you own, of the Magnite shares, is actually reached, right? So we set the sale strike price of the $22.50. We automatically sell the 100 Magnite shares to that person. They get those shares. We receive $2,250 for those shares that we own. We don't own them anymore. Plus we keep the premium. That is $125 for the premium. So we've gotten that. The total proceeds that we've received from this covered call are $2,375, which is the $22.50 plus the $125 premium. So that means that we sold those shares, those Magnite shares, for $23.75 each. Now, if you bought them for $19.50, you've done well, right? So let's presume our purchase price was $19.50. That was the day we bought the shares, and we wrote this covered call contract as part of our strategy. So our profit is $425, which is an ROI of 21.79%. Pretty big, right? Now, the reason this strategy on this share is as high as it is on the ROI is because Magnite is a pretty volatile stock. That means that people who are doing options trading are willing to pay more for the gamble. A lot of these guys they're not actually fronting the money; they're doing it on leverage credit. So they're willing to take the gamble that they'll be a winner on this trade. What that means for you is because you own that stock, you're going to really profit if they're on the wrong side of the trade. Now let's presume that the strike price isn't reached. It doesn't hit our $22.50. What happens at that point? Nothing. You still own the 100 Magnite shares, or whatever shares it is you want to put in here. It could be anything. And you keep the premium. So you get the $125. You still own your 100 shares. You paid $19.50 for the shares. Let's say the price of the Magnite is $20 and it never hit your $22.50. You still own the shares. And you made a profit of $125 off your original investment of $1,950, which is an ROI of 6.4%. Okay, so you can see the benefit of this strategy, especially using it on US shares versus UK, because of with the UK having to have 1,000 shares is more difficult. You gotta have more money. So what happens if the stock price falls? What happens if you bought it for $19.50? You wrote your covered call for $22.50. It didn't hit the $22.50 price, but let's say the stock price drops to $16. Let's say Corona 3.0 hits and the market tanks. You've written your option price at $22.50, the share that you own. The price has gone down to $16. What happens? Nothing. Absolutely nothing. You wrote your covered call. You collected your premium. You still hold your stocks because it didn't hit the strike price. What you do, you just hold the stock until it recovers, or you continue to write covered calls above the purchase price. You're going to have lower premiums because the higher you try to price you try to get for your shares. Let's say we're looking at January 15th. You can see here the higher we tried to target on these Apple stocks. So right now it's 122.89. If we are trying to get 165, you can see the premium here now becomes very small, 35 cents a share. So $35 US for 100. Excuse me. So if you bought your shares at $19.50 and now the shares are $16, you've got to set your strike price higher than $19.50. So if you set it lower than $19.50, you're going to lose money on your stocks. You don't want to do that. But you're going to receive more of less of a premium. Right, so let's have a look at Magnite so I can show you that. All right, let's look at the options. So, for instance, and this is not a very good example because there's not a lot of trading activity on Magnite. This is not a very well-known stock. Normally, you'd have a lot more options than this, but let me look at, say, Pfizer, for instance. All right, let's say I bought Pfizer for $44 and the price tanked all the way down to $39.82. What I've got to do now is write my options for higher than what I paid. So I paid $44. I don't want to be writing them for $41 or $42 because I'm going to lose $3 on each stock. So what I would then do if the price was down here at $39.66 and I'd paid $44, I'd write the option for say $45 or $46. You can see here I'm still getting a 77 cents premium to write the option at $46. So even if I paid $44, it dropped down to $39.60, and I write my option at $46. I'm still in good shape. I can collect that $74 premium for my 100 shares. And again, if it doesn't hit that price, I get to keep that premium. If it hits the price, I make my $2 a share because I paid 44. It gets sold for 46. So I'm getting paid $200 on the uptick on the shares, and I get the premium. So even if the shares go in the down negative, you can still use this strategy to make smaller amounts of premiums to get back to your price where you purchased them at. And remember, every time you're collecting a premium, your average price that you pay for the share is decreasing because you're collecting premiums. So that means your share average price paid now is reducing every time you collect a premium because you're collecting that income. So the covered call strategy, what's the pros? We keep the premium no matter what happens. If the sales strike price isn't reached, you keep your shares and you keep the premium. Also, another huge benefit, if you time it correctly, you actually get the dividends on the shares too. So that increases your return. By the way, I've done this on a very conservative stock called Dow Inc., which is a US chemical stock. And between when I started in August to today, I've made about 9%, which, is pretty good. We're talking about 4 months, a little bit over 2% a month. And again, the risk involved in this strategy, I think, is a lot lower than any other risk out there, especially in the options world. Even if you're just trying to trade stocks, without using options, you're taking risks because you don't know when the ins and out points are. So I like that it's a pretty steady way of collecting income, and it's maximizing your upside as far as the amount of risk that you're taking, but it's also limiting your downside. I like that. One of the pros too, you can also close the trade out early on a covered call. You own the shares. If you want to close the trade out early, you just pay whatever the market price is and you can get out. It's very easy to do. What's the cons? The biggest con of this strategy is, let's say you're writing your covered call for your Magnite shares at $22.50 and the stock goes on a tear and it's worth $30. You've missed that extra upside on the stock. Okay, so you got that. Also, the stock price may fall below our sales price, meaning that we own shares that are worth less than we paid. But again, that wouldn't matter because if we want to own the shares for long term, you'd have been holding the shares anyway. One of the other cons is you need enough cash to buy 100 or 1,000 shares, whatever it is you want. You've got that risk of not being diversified because you're trading single stocks. And if you mistime it, and this happened to me recently, I think I was a week out from an options expiration and there was a dividend that was going to get paid the next, I think it was 6 days before the option was expiring. The other person on the trade closed out the trade, got my stocks, and then collected the dividend. So the best way to do it is when you're doing it with stocks that pay dividends. Dividend stocks have things called ex-dividend dates. You want to make sure that you write the option very close to the ex-dividend date. That way you'll be owning the shares on the covered calls because you own the shares. You'll be owning them into the dividend date, which means you'll make extra returns because you're getting paid the dividend. You don't want the other person on the other side of the trade to get your dividends. So if you mistime it, that can be a real con. So yeah, that is the wheel strategy. Probably didn't make a lot of sense to you. I'm not the best at articulating, but just imagine this strategy is saying, I want to buy a certain share. I'm going to set the price that I'm willing to pay for it, and somebody else is going to pay me a premium to agree to buy those shares at that price. That's called a cash secured put. That's on one side. On the other end is if you get assigned those shares on that put, or you already own the shares, you can write a thing called a covered call, which again, you get paid a premium for writing that option, and you get to decide what price you want to sell your stock at. So for instance, Pfizer today, if we were writing an option on a covered call here, the Price is $39.74. We can choose what price we decide we want to sell the stock at. We could choose something as high as $47 or $48 and still get paid a $45 premium. We can do a lower amount. Let's say we only want to make $1.30 on the share. We can get paid $185 premium. That's 1.84 per share. And then you get to decide if you want to do a shorter term. You can do every week if you want. You can go, say we're the third today, so you could go on a December 11th option, and you could write it for a week out at 41.50. So, and then again collect that premium and just keep collecting and collecting and collecting. Now, the more volatile again the stock is, the higher the premium amounts are. You can get some crazy premiums, like for instance, this Aurora Cannabis is a stock I was looking at putting in the portfolio. You can see some of the premiums on this for just 2 weeks out. The share price is only $11.25. You could get a $2.81 premium. Sorry, got that wrong. Okay, you can get a $1.41 premium on a stock that only costs you $11, so that's almost a 10% premium to agree to sell your shares at $12.50. So you'd make $1.25 on the uptick of the share rise in the price, plus $1.43 on each share. So you can make a pretty hefty return. You just got to remember these stocks can be volatile. So the more volatile the stock is, the better you're going to get on your premiums on the trade. If you go for very conservative stocks like Coca-Cola, for instance, you're going to see the premiums on those are a lot smaller because those stocks don't move as much. So here's Coca-Cola. You can see expiring January 15th option. You're going to get paid 66 cents on 100 shares to agree to sell them for 55. But you start getting up into $60. You can see the premiums absolutely next to nothing. This Coke tends not to be a volatile stock, plus there's a dividend. And sometimes these prices adjust depending on when dividends are going to be paid. If there's a Coca-Cola dividend coming up in that period, those options prices reflect that. But I'm going to be talking more about this type of strategy and how you can use it to buy and sell shares. I think it's a pretty interesting one. It seems complicated. There's a really great book that is very simple to read and understand, and it's called Covered Calls Made Easy. It talks about pretty basic strategies on how this whole thing works. But again, if you're looking for yield, you're looking for a way to gain income, you're not going to get it from the banks. It's not coming anytime soon. I don't think interest rates are going to go up for the next 2-3 years. Peer-to-peer is an option, but for somebody that doesn't like peer-to-peer lending anymore, you can look into this option. Again, if you do it through cash secured this way, you own the stocks in the covered call section. So you're not really risking anything, especially if you have stocks that you want to own anyways long term. The risk is very minimal. You own the stocks, you're setting a price to sell at. If the price gets hit, you sell them. If it doesn't, you keep them. And you get paid a premium for doing so. So, as far as Dave said, who can you do this through in the UK? It's not very common. It's a lot more common in the US, but Interactive Brokers is one of the platforms that does it. In the UK, I would recommend them to do it. Yep. So I think I did look at some of the other ones. eToro does not do it. Some of the other, and don't get confused between that and CFDs, completely different. CFDs is margin trading, which I don't recommend. This way, you're not taking as much risk, but Trading 212 doesn't allow you to write these types of options. It's not common in the UK. It's not very well known, but Interactive Brokers is the place I would go to look at that. Yes, I have gone on for over an hour. that's going to do it. I'm going to make a simplified video explaining this if you'd like to learn more about it. I think it's something that everybody should really look at. It's not as complicated as I probably made it sound, but you have to look at ways to get yield nowadays, and I think this is a really interesting way to do it. I don't think, think places like Charles Stanley, Hargreaves Lansdown, you're not going to have this type of option. So you are going to have to do it through a brokerage. I think it will become more common in the UK, as time passes, but right now it's a very unknown thing that a lot of people don't tend to use. So I hope I explained it okay. I'm not the most articulate person. I did like the little artwork that I did here. I mean, I was really proud of that. I kind of messed up the G. I had to kind of go in and redo that. But I hope I explained it. If you have questions, you can put them in the comments on the YouTube channel. I'll try to answer what I can. Maybe you don't understand it. It might not be for you, but check it out. Interactive Brokers. Yes, the 1,000 share thing is a problem in the UK, Dave says. It is, but you can also do it on shares that are not very expensive. If you own things like Lloyd's Bank, some of those cheaper shares, you can do it for 1,000 shares. It's not the end of the world if you're paying 28p. But yeah, that is one of the issues. Anyway, I'm going to wrap it up. Hope you guys have a great week. We'll have Narinda next week on the 10th, December the 10th. Hopefully, all being well. And that was my lesson for the day. That was thrown together very quickly. And I hope you got something out of it. If you did, hit that thumbs up button. Hit the subscribe button. Go to financialthing.com. Yes, watch the video over. It'll be archived. If you didn't understand what the hell I was talking about, you can rewatch it again. And I'll continue to test the strategy out and see how it goes for the next few months. I think it's going to be a good strategy. So anyway, take care, everybody. See you soon, and have a very prosperous week and stay healthy. It's great. Thank you for joining me. Take care.